In this video, traders, we're going to look at trading on other exchanges, the pros and cons. Stay tuned. Hey guys, warm welcome to you. Alright, so if you're thinking like I have before that, hey, there are some other countries that are significantly smaller in terms of the exchange size or in terms of market cap and liquidity and all this, but they may offer opportunity, then maybe we can consider now in this video the pros and cons of actually trading on the exchange. So what I mean here is the majority of us will probably most likely trade on the US, the UK, major European exchanges, maybe Australian, maybe Japanese, maybe some Chinese. Those kind of bigger economies attract most of the liquidity and most of the trading activity, as you could expect. Of course, India up and coming as well with the Nifty 50, etc. Very strong kind of trading markets as well. But what are the pros and cons of us saying, okay, well, why don't we look for a smaller country that still has a stock exchange and trading on there? Well, the first thing is many countries don't allow foreign investment. So if you're looking at some specific countries, then it's very hard as a kind of citizen outside the country sometimes to trade directly on the exchange. You know, you've got a lot of hoops to jump through. There's kind of things that you need to do with this, and it becomes a bit challenging, which is why there are a lot of ETFs out there that will mirror those exchanges or the broad, if you like, broad exchanges that we want to trade. Now, it becomes a little bit easier to trade the index, or the indices, should I say, because many of the spread betting providers, CFD providers, etc., will allow you to trade those indices. But I'm talking about if you're trading the stocks. I'm talking about if you want to trade and you want to type an edge. Now, on the trade an edge, there is a thought process that says, well, actually, are the investors less sophisticated? Now, I don't mean that from a perspective of the people. I mean the perspective of, are there algorithms that are sometimes damaging some of the exchanges here? Are they missing, or are they less sophisticated in terms of technology? Because the reason I say this is not to put down any exchanges, of course, but if we imagine Goldman Sachs as an example, they go where they can make the most money. They're not going to be interested in a smaller exchange necessarily, because there may not be enough money, enough liquidity to make it worth their while. It's not to say they haven't got presence in all these, I'm sure they may have, but that's the thought process behind it. There aren't bigger fish in the smaller exchanges because they're offering the right size meal, if you like. Whereas for us as retail traders, maybe we could work in these exchanges using the skills that we've got from the trading in the bigger exchanges, and perhaps being a little bit more efficient in those. So that's one side of looking at it. The other side, though, is to say, well, these, at the end of the day, guys, human nature is the same wherever you are. You know, I believe that 100%. Doesn't matter what country you're in, we're all identical in the way we think about things with fear and greed. You know, this is human nature, and it's spread evenly across the world. But we might be able to say, okay, so that's the pros. We might say, okay, well, perhaps if there aren't so much algorithms in there, aren't so many institutional investors with bigger money, does that make it easier for us? I'm not sure. It'd be interesting to hear your comments on that. The cons of it are this: what are the regulations like? What are the rules like? What's the reporting like for the company? So what's the insider trading rules like? You know, who are you up against? Who are you trading against? What are the little quirks that might mean that it's not efficient to trade it? Is there some kind of stamp duty, like in the UK? If you go and you buy shares directly through a bank or through a broker, a traditional share, you have to pay a stamp duty. You might not be aware of that if you weren't from the UK. And so there are ways around it with the CFDs and spread bets, etc. So there's this legislation, there's laws. Understanding those. Then there's, of course, the opening account, which I alluded to earlier. What about the currency risk? If you're trading an obscure exchange somewhere in another country, you're going to have potentially an obscure currency risk. Now, a lot of currencies are pegged to the US dollar, so if you're trading US dollars, it's not the end of the world, but you've still got that exchange risk where you've got to change it. Even though it's pegged, there's still an exchange spread, if you like, you've got to worry about. So pros, potentially opportunities in smaller markets that you might not get elsewhere. Cons, there could be some legislation, there could be some laws, it could be different, it could be a little bit, the hours could be challenging, and you could have trouble opening the account, you could potentially have problems with your exchange rate, etc. However, there are hedge funds out there who specialize in spotting opportunities with specific companies in those exchanges. So why might you do this? You might see a company, for whatever reason, you think is going to do very, very well, but it only trades on that exchange. And so your trading would be based on that exchange, on that company. Now, like I say, it may well be worth looking for an ETF that contains that company and potentially getting some exposure, especially if it's a big weighting in the ETF rather than trading the individual company. Otherwise, it's pertinent and it makes prudent sense to go through and check that all those things, laws, etc., as talked about, are on your side and can work in your favor if you choose to go and trade on another exchange. But the other thing, guys, completely other thing, is there's more than enough opportunity with the US exchanges, UK, Germany, France, Australia, Nikkei, etc. Loads of opportunity out there, thousands of stocks, thousands of markets, hundreds and hundreds of thousands, in fact. But if you wanted to trade where you felt the bigger fish weren't playing, like the pro, then maybe trade some of the smaller caps. Trade some of the smaller caps in the US specifically. Big fish aren't that interested in those. Liquidity is not enough money to be made in it. Potentially, if that's your edge, then maybe it's worth trading those. Trading on the AIM market in the UK and looking, so you haven't got all the potential hazards, but you maybe have the benefits. Anyway, guys, that is trading on other exchanges, the pros and the cons. See you next one. Take care. Bye-bye.